Results out from Wilson Bailey Homes Ovken this morning show a 12.1% rise in revenue for the 6 months to December, with headline earnings a share up almost 19% and its dividend up 10% to R1.10. Joining me in studio now to take us through the past 6 months and the road ahead is Mike Wylie. He's the CEO of WBHO. Mike, thanks for coming into the studio today.
Pleasure.
Mike, you listed a whole number of projects you've been involved in over the past 6 months, including 3 of the World Cup stadia, number of shopping centres, we have hospitals, warehouses, the King Shaka Airport in Durban, just to name a few. Though you do say in the commentary that there has been a slowdown in the number of contracts that have been awarded. What's the pipeline of work going forward looking like, considering that the stadiums have now been built?
It's interesting. There does appear to be a good pipeline. Just looking at the budget, they still have the figure of 800 billion odd. We think quite a lot of that work has already been awarded, like the power stations, like Kusile. Quite difficult to unpack those numbers. But at least there's work there. We just, I think as we said in our commentary today in the newspaper, that we believe we've got to be very cautious in this period now. I think it'll be a while before we see the type of construction activity we did see in the last 3 years. But it's not all doom and gloom, and I think we just need to be cautious now for the next 2 years and wait. I think construction companies are always sort of last into a recession, and maybe we come out a bit later as well. So even though things look a bit, reasonable, the prospects look good, I think there's a lot of competition. All these projects require a lot of capital, so capital is under pressure. Yeah, so it's an interesting time.
You do have quite a lot of capital though, so your capital position has improved over the 6 month period compared to the year earlier.
Yes, we have. I don't know if you saw there, we have no debt at all, and our cash is strong. So that's a nice position to be in, and we hope to be able to make good use of that over the next 2 years.
Now, I know there is some concern in the market just with the 846 billion rand that has been set aside for infrastructure, whether somebody's actually pushing the button and signalling the go-ahead to spend that money. You said that some of it has already been allocated. Is it being allocated fast enough? Do you see that money being spent?
I think that's the concern, and that's why we going to manage ourselves very cautiously. You can see our capital expenditure was way down on what it has been in previous years. So we're anticipating that capital expenditure for all the parastatals, private clients, wherever, will be slower, because I think everybody is very cautious, and credit committees are on their toes in pushing the buttons for big capital projects. So I think we're just going to have to be cautious with it. So we don't have any expectations of huge amounts of spend. And I think my experience in the industry says that we've gone through a great 2 or 3 years. We must probably more now inclined to be where we were in the 80s and 90s, and things are going to, I think, be a bit slower. But at least there is the talk, there is that money, there are the projects to do. The government wants to improve infrastructure. So I think there's a lot of positives, but I think one's just got to be cautious with it.
How about outside of South Africa? You said you put some of your excess capacity from the Western Cape, where there has been quite a big slowdown in the building sector, up to Zambia, where you're building a shopping centre. You've also increased the stake in your Australian subsidiary. Are you seeing more growth opportunities coming from outside of South Africa at this point?
Yes, Australia has surprised us that they do seem to have escaped the worst of the global financial crisis, but Australia is a very competitive market, and so there will be small increments in growth and profit there, and there are opportunities. I think there's always opportunities in Africa. Africa, we think there's going to be a lot of resource opportunities, and we're already seeing that. And so we're fairly sort of well balanced. I think 40% of our profit and turnover is external to South Africa, 60% is internal, 30% is with government, 30% is with private sector of that 60%. So we think that's a nice place to be. We can sort of move quickly in and out of those spaces, just depending where the spend comes. So we just watch it very carefully. And so we'll see how it goes.
You're also talking about the Middle East, and of course we know that some construction companies were hurt in the Middle East last year. What sort of opportunities are you seeing there?
We have an office in Abu Dhabi, and we don't have much work at all, but we are tendering. So we don't, again, have too many expectations in that region. It's very competitive now. I think everybody from Dubai has gone to Abu Dhabi. So we'll see how that goes, but we're not relying on anything there.
Mike, your operating margin up to 7.9% from 7.3%, really being driven by roads and earthwork where the margins are quite high. You do talk about competitive conditions though. Do you see this putting pressure on margins going forward?
Definitely, I think there will be pressure on margins. Our margins the previous 6 months would have been higher, but we had a bit of bad debt. So, our most probably realistically our margin has come down quite a bit. But I think that 7.9 is strong, and we hope to keep it around there. We'll just have to keep our costs down, really try and get everything we can out of the various contracts we have. So it's really going to be tough, hard work now to keep things going as they have been in the last few years.
Well, your order book came down from 15.3 billion rand in June last year to around 13 billion rand at the end of the financial year. At the end of the 6 months. How's it looking a couple of months into the second half?
No, that order book is, I think we're reasonably happy with it. In the 80s and 90s, we were always happy with 80% or 90% of our order book of annual turnover. And I think we're about 88% now. So we obviously got higher than that, with these big projects when they come on board. So we think that's okay. But to maintain it, it's going to be, there's a lot of tendering going along, a lot of negotiations going on. So to pull contracts across the line now, is a lot more difficult than it used to be.
So Mike, just looking ahead, could we say you're cautiously optimistic about the remainder of the year?
Yes, we're cautious. It obviously won't be as good as the second 6 months of last year, but we hope we'll maintain our position versus the previous financial year.
Mike, we have to leave it there. Thanks very much for coming to the studio today.